In terms of what we've seen from the PBOC, what do you think this tells us longer term about their views on the currency strength that we've seen over the last few months? And what are the practical implications, do you think, for the economy going forward here in China?
Well, I'm glad you asked me about the renminbi and not the LA Lakers. I wouldn't be able to add much value on the U.S. basketball scene. But in terms of the renminbi, look, it's a tactical move that we've seen by the PBOC to remove these reserve requirement ratios for shorting. It's really meant to bring back two-way expectations. We've seen the yuan rally quite hard. There's still a structural issue whereby the PBOC is keeping relatively tight monetary policy. The Fed has its foot on the gas. And if you just extrapolate that, it would imply further yuan strength. And really, the PBOC is trying to lean a little bit against that. But it's a tactical move. It's not necessarily something that will be a game changer in terms of how we would have to think about broad FX direction when it comes to the RMB.
OK, when we last spoke to you, I believe in July, Fred, about the Chinese economy, you pointed to concerns around a weak consumer, a lack of tick-up in terms of construction, services, infrastructure spending. Do those concerns persist for you? Where are we, do you think, in terms of the economic recovery here?
Well, it's been really a fantastic third quarter by all measures. If you look at construction, it's still going gangbusters. In fact, if anything, housing construction is running a little bit too hot. And the broader property sector is actually moves afoot to try to rein that in a little bit. But there's still some concerns about how strong the consumer really is. I know we've had very strong Mid-Autumn Festival travel numbers, for example. But if you look closely, we're not quite back where we want to be. So you'd still characterize this as a fairly uneven recovery. I wouldn't make too much out of this, but it is probably strong enough for the PBOC to continue to remove a little bit of the accommodation. And that explains, again, the strength of the renminbi versus other currencies, is that divergence in monetary policy. But yes, so it's still an uneven recovery. But, you know, by global standards, it's really a standout by any measure.
So, Fred, I mean, there's some that were saying amidst all this volatility that the renminbi could be seen as achieving some type of safe haven status. Can it, given just the capital controls we've seen on the currency itself and the moves that we've seen from the PBOC over the weekend, or is it just a good trade?
Well, I mean, safe haven is maybe stretching a little bit. Obviously, there are still concerns about convertibility. Having said that, though, remember they have removed a lot of the inflow controls for non-residents. So as far as foreign investors are concerned, it's a good diversification play. And in that sense, it offers some security. It offers a bit of an anchor in an uncertain world. But it's certainly not yet a Swissy or a yen or anything that you consider a true safe haven. There's still risks here. It's still an emerging market technically. So we're not quite there yet, but it has made great stride in terms of bringing in foreign capital. It's a diversification play that has a long way to run. And because the Chinese economy is less correlated with what's going on elsewhere in the world, that diversification is playing itself out, not just in terms of reallocating portfolio flows, but as really a fundamental justification in terms of the cyclical outlook of the economy. And from that perspective, you'd expect the inflows to continue for quite some time.
So the debate rages on in D.C., of course, Fred, but would you say that when it comes to COVID, that this has really marked a regime change where fiscal policy now is going to take the reins from monetary policy?
Yes, and it's in part because central banks are running a little bit out of ammunition here in order to revive growth. But there's more than that. Fiscal policy in this type of environment is just more effective. And there's really two types of fiscal policy. One is the stuff you really spend during the pandemic for humanitarian purposes to really help support incomes. But then the big fiscal push also needs to come during the recovery. And if we assume that the virus fades from the scene in 2021, hopefully there's still going to be need for more fiscal push, really to nudge economies along, to get them back on the track. So there's a second round of fiscal stimulus that's still needed, not just in the U.S., but across Asia as well.
How long can they keep the taps open, though, Fred? Because at what point does this become dangerous? When will the bond vigilantes come out? And what are some of the consequences we could be dealing with?
Well, the bond vigilantes are cowed by central banks who have much bigger bazookas to throw at the market, and so that helps things to keep on an even keel. The limiting factor here is really inflation. If you think inflation comes back next year, then that would be a limiting factor. But really, all indications are that we still have enormous output gaps, that if anything, there could be a deceleration in inflation going into early next year. So that is not really a limiting factor for the time being. That doesn't mean there's a free lunch here. You need to essentially boost growth now, but you also have to have credible consolidation strategies in place for the coming years, especially emerging markets like Indonesia, for example, Philippines, India. All these economies that are still spending will have to signal that ultimately there's a credible consolidation path. If that credible path is not there, then obviously it could immediately be reflected in exchange rate volatility. That's going to be one of the big concerns in 2021.
Okay, Fred, you touched on inflation, and you don't see it as a risk to that strategy in the short term. But we are seeing inflation challenges in India. We're seeing signs of food inflation here in China. Are those idiosyncratic to those countries, or do they point to something that is brewing, at least, that investors need to wake up to?
It is idiosyncratic. That's one thing. Individual markets have certain factors like food prices, for example. But there's something else, and that is after a big collapse in activity, very often we see prices in the first few quarters go up because there's supply shortages, because there's disruption to normal economic activity. Once that returns, then you actually get the disinflationary shock really come through. So it's a delayed response, if you will, of inflation to this big dislocation and growth. And that's why going into early next year, places like India, for example, are going to see a rapid deceleration in inflation. But even across the rest of Asia, think China, for example, we're going to start 2021 at inflation rates lower than they're currently.
And so you talked about the need for fiscal stimulus in this part of the world, combined with a convincing plan, a plan that will convince investors, no doubt, to keep their money invested. Where are you seeing evidence of that in Asia, and which countries are lagging? Which countries are behind in putting those two things together?
Well, if you look at the Philippines, for example, they have passed a law which very credibly states that there's only a certain amount of money that the BSP, the local central bank, can do to finance it. There's a legal structure here in place that provides credibility that there's not going to be open-ended central bank financing of the deficit. That's a very credible strategy. In Indonesia, ideally, we want to see some sort of a legal reassurance as well, possibly next year with a revised central bank law, for example, that provides a very firm basis that puts some kind of framework around the amount of monetary financing that could be done. We know that the government has hinted at potentially using again the BI financing to help next year. But it's really important to put this into a legal framework that is credible for investors, so you get no intermediate volatility in exchange rates and markets, because investors may have sort of some doubts about the long-term strategy here.
And in this whole talk about aggressive fiscal spending, the one economy that's kind of fraying from it is China, refraining from actually pursuing this. Are critics right to say that the government is not doing enough on that front?
So the Chinese actually have had the luxury of seeing a very short COVID-19 spread through the economy, and that has also reduced the overall need for stimulus, because there hasn't been this ongoing months of undermining confidence. And so the overall need has always been lower in China than elsewhere, just because of the better containment strategy at the beginning of the year. Now, that doesn't mean that China's support can now stop. There's certainly ongoing need for fiscal stimulus, but on the monetary side, because of concerns over inflating asset prices, particularly in property, you probably see a bit more tugging of the reins here, just to make sure you don't engage in another round of excessive debt growth. So China has, one foot on the gas on the fiscal side, but is tapping a little bit the brakes on the monetary side, whereas other governments have to have both feet on the gas and going full on into 2021.